Is the market changing due to a shift in political winds? Stay tuned. Well, hello, everyone, and welcome to episode number 228 of NoteSchool TV. And this week is, well, it's a big fan favorite. It is our end of February monthly update. We'll get to that in about a minute and a half. Before we do, go ahead and hit that bell notification so that you'll know when we go live every week. Number two, if you haven't already subscribed to the NoteSchool TV channel, please go ahead and do so. And number one, just make sure and share the presentation this week. This is the biggie. This is the one that everyone loves to see. So make sure and share this with all of your friends and everyone you know out there, right? Whether they're friends or not. And then lastly, if you want to know how to get involved with NoteSchool, just simply go to noteschool.com/TV. Again, noteschool.com/TV. We would be glad to have a conversation with you about, well, how to come to one of our NoteSchool classes. With that, well, I want to introduce our Chief Visionary Officer, founder of NoteSchool, all-around good guy, Mr. Eddie Speed.
Good morning.
Good morning. It is a lot of stuff going on in the market today, in the world as well, but specifically in the real estate, in our world, right?
Yeah, I mean, I think some things the market is, we'll talk about it as we get through specifics. Some things, the political winds aren't going to change what the current market conditions are. And
Right.
On the other hand, there's going to be things that, that are influenced. And so we're going to kind of go through that, but great information today, and I'm excited to do it. So let's crack it open, Joe. Let's talk about the housing market.
Let's talk about the housing market. So, Eddie, 10 cities where home prices are falling the most. San Francisco, which is number one there, right at 11%. You can't get any closer on San Fran. And you look at the difference there. You look at the median price of $889,500, and then you kind of scroll down. Interesting. Austin is the only Texas city in that grouping, Eddie. But I think there's three in Florida.
A lot of Florida.
A lot of Florida. And you go down to Orlando, and the median price is $419,950 and down about 4.3. And interestingly enough, the median price of a house in the United States now, overall, globally, is about $402,000. So Orlando's right in there as far as the pricing, but still down 4.3% year over year.
Yeah, I think there's a couple of things worth noting here, Joe. First of all, I want to point out how many Florida situations are in here, because that's probably worth noting in their top 10, right?
4 out of 10 is pretty high.
And the other thing that I think is interesting of the cities that you're not used to seeing is, I would say, the most surprising to see in that group is Cincinnati. Yeah. Pretty interesting. All right. That's really, like, Joe, I like what you and I were talking about. Like, we can gather data with arguments about real estate values either way.
Yes.
And we can go take you to sort of like what we would sort of call the hedge fund level reports, which are used, or which are calling for, kind of a flat market to a decline market this year. Then we can go to, other groups and JP Morgan, and the market's going to go up by 3%.
Right.
So
absolutely.
We've seen this now, Joe. We've seen this argument now for 3 years. And,
we have.
I guess what we're saying is that, days on the market, the builder situation, those influences seem to be influencing a lot of the advisory groups that really advise the biggest money in the business. That seems to be influencing their decision as much as anything.
Yeah. So, absolutely.
Yeah. All right.
So these are existing home sales, homes that have been built. Homes have been around a while, down 4.9% in January. Biggest decline, Eddie, since November of 2022. And so it's not only existing homes; it's the new construction as well, with the Toll Brothers and D.R. Horton and all of these other big builders that are suffering the fate of that as well.
Well, let me make it clear to everyone. This slide is for existing home sales.
That's right.
In addition to this slide, you have a decline from the builder world.
Yes.
And so that, and they seem to be following the same track, which is a decline in sales.
Yes.
Right? So this is what we talked about. This is year over year listings, and we started tracking this. Joe, your city down there, or your state down there, they're becoming that's becoming a factor.
Well, and that's down a little bit, but still dangerously high as far as all of that goes. And Eddie, again, we kind of joke about this. I think the only state on there that's showing a negative is a good old North Dakota up there at a -2. Everything else is down. There's nothing that's
all right, I'm going to draw a circle here, Joe.
Yep.
Okay. I'm going to draw a circle here.
Yep.
Because we're going to go back to this and look at affordability here in a little bit.
Yeah.
And I want you to notice there's a pattern here.
Yeah.
Right. There's definitely a pattern with affordability that is trending over into what we're seeing listings year over year. So just know there's more to come on this, but we're watching the fact that certain markets, let's just kind of say, are raising their hand, right?
Yeah.
There's our friends in Georgia. They're kind of seem to be raising their hand a little bit as well. Texas, kind of the mid part of the country, they're in the 25% range. Not great, but not quite as bad.
Yeah.
And inventory listings, Joe, are
but you can see how they shifted from January of 17 to 18 all the way through 25. And so there's a lot of inventory in 2017. It goes up, it goes down, but we've got a lot of inventory if you look at the last 21, 22, 23, and 24.
Yeah, I mean, if you look at the prior years, we're up quite a bit in listings, right? If you go back, of course, it was ridiculous here, right? That was crazy. Then it got really ridiculous. Then in 23, and 24 are about the same. And so we're up, we're up a pretty good amount, right? Yeah. But what's weird, Joe, is we're not normal.
No, we're not normal.
This is normal. Right? This is normal. And go look at 17, 18, and 19. That's normal listings.
That is absolutely right. There's nothing crazy that it was too many listings. It was just
we're below normal here. Mm-hmm. And that's what we're trying to say is what is normal? It's kind of like, I don't know. Which way are we going, Joe? Are we up or are we down? Well, we're up from the last few years, but we're not up to normal yet.
That's right.
When are we going to get to normal?
That's when we talk a little bit in the next category there. We're going to come back to that. So,
all right.
Fitch says U.S. home prices are stabilizing, but 85% of the markets are still overvalued by 11.1% on the population weighted average basis. So it's down a little bit, but month over month or from December, but it's still 85% are overvalued.
All right. Good to know.
Yep.
So what's driving it?
Affordability.
No argument about that. Okay.
This is the U.S. market facing historic decline. We know this, Eddie. Mortgage applications down 63% from the pandemic peak. It surpassed the declines we saw at the 2008 when the financial crisis started. And compared to pre-pandemic, we're down 52%. This is the one I was talking about. So we're talking about inventory. The second bullet point there, where it says mortgage rates around 7%, and this is the first time I've seen this, are not, from the news media, are not historically abnormal. They're not. We've been saying that for how many years now, Eddie?
Yeah.
And it says they are now compounded by home prices that are 80% above long-term average.
Yeah. Affordability crisis is deepening. And Joe, it's funny. I was on a call this morning with a very, very high level real estate investor that has a big influence over a large group of very active real estate investors. Very brand name if I told you it was. Right. And I made a statement this morning. I says, everybody talks about affordability. Nobody talks about credit except us. Yeah. I think we're the only guys out there that make equal emphasis to credit and affordability. Mm-hmm. Everybody puts it on there that it's all about affordability. And I am not saying that's not a big factor, but that's why we always have the updated mortgage credit availability index, because both of those are what are driving numbers.
That's it.
I think.
So, Eddie, this again, it's came down a little bit, but this is just the national payment to income ratio. We're at 33%. You can see that, gosh, I think it was back in 2001, way over on the left side, we were way up there. But this is crept up, and it's just another affordability issue, right?
Joe, seemed like there was a spike in there. You know what I'm saying?
Yeah, there was a spike in there. We see those spikes, and if you look at a graph, you're going to see of the last 5, you're going to see a lot of different spikes.
Yeah.
Yeah.
All right. I think, Joe, you remember when I circled and I told you I was going to go back to this?
Yep.
Now, what we said were increased days on the market. And if you remember, I circled Arizona, Colorado, Utah, Nevada, and I circle those, right? Maybe it's another way of circling that where it's easier to see.
Right.
But I circled all of those states because if you remember, they were up at a north of 100 and about 30% increased listings, right? But what's interesting is it also matches the number of days that it takes to make your mortgage payment.
Mm-hmm.
Whoa.
Yeah, you just drop the mic and walk off on California, right? And Utah and Arizona and everything, right? I mean, it's not everything, but most of that is what it is. And Eddie, that's based on, you can't really see it on that on the right side there on the top where it says mortgage payment, but that's based on a 5.8% 30-year fixed. If you're at 7%, then that's even exacerbates the thing. But Hawaii is the biggest, right? At 33 days. So you got to work. You got to be a hard worker, dude.
It's worth noting. In fact, I was at an event the other day and somebody had seen this chart. And I said, yeah, pretty sure that's going to be on our market update that we're going to do here next week. And so I just, this tells us like, this should be a good indicator of like where we're at in the market.
Yeah. Yeah, the Beatles had a song early on said 8 days a week, and that's about what it looks like.
Lordy.
Yeah. So the big topic right now, along with a lot of other interesting topics, is here's what the privatization of Freddie Mac, Fannie Mae may mean for home buyers. Eddie, they've been in conservatorship by the feds for 17 years. If not done well, mortgage rates could potentially climb higher. Mark Zandi, that's the chief economist at Moody's. It's just a question of how much higher. And, I love this. So the 30-year fixed rate mortgage might not even exist without them. We look at our cousins to the north up in Canada, they do not have a fixed rate mortgage. Everything there is an adjustable rate. And they command a huge presence there. 70% of the mortgage market goes through the Fannie Freddie piece there. So
yeah, so people think FHA and VA are they don't represent near as big a percentage as Fannie and Freddie.
Yeah,
right.
Yeah.
And yeah, I don't know. I have some friends that are very connected in that space, and I think we all kind of look at it and think, we tend to do better when we're not have government over our hand over the top of us, right? So I don't know. This didn't make it sound very good. I'm not sure that everybody agrees with that. This might be one writer's opinion, but I think it's going to happen.
Yeah, I think it will. Yeah, for sure.
All right, let's look at mortgage rates.
They're about where they were in January. They're vacillating back and forth between, on the interest rate side, between 6.9 and 7.1, 7.2. Again, you would think that 5-1 ARM, we joke about that, but you look at the APR on that. It blows my, but that's the way it's been, Eddie, for 4 years, right?
Yeah, it's not. Nothing's changed. It just isn't what they thought. And once again, you hear Joe and I talk about all the time that we pay attention to the APR, not just the interest rate that is the face rate on the note. What's interesting about 30-year fixed is the interest rate and the APR are almost twin sisters.
Yeah.
And that is very abnormal.
It is, yes.
Yeah. All right, let's talk about your man over here, the Fed man.
We haven't had
his job, Joe.
We haven't had a picture of Chairman Powell in there so I felt like we just had to, right? So these are the forecasters in the survey of the experts that are around, and there was over 100 of them, and 67 said, or 2/3 said that they expected at least one rate cut by the end of June. Now that kind of goes into the face of a lot of folks who are saying, well, we're going to have these rate cuts. 22 are saying a rate cut in March. Most don't believe that. And then 45% say no rate cuts at all in the first half of 2025. So only the shadow knows, right?
We're sounding like we're 50-50 on that one, Joe.
We're 50-50. Yeah.
Aren't we 50-50 on real estate values having a slight increase or decrease this year?
Yeah.
We're about 50% on saying the Fed rates are going to go lower. And by the way, Fed rates, everybody knows this, right? Fed rates don't necessarily affect mortgage rates. That's more the 10-year bond rates.
Well, and by the way, Eddie, all of the research over the last few days, the 10-year T-bill it's where the Fed wants it. It's about between 4.5 and 4.58. There's usually right now there's about a 2.5% spread between the mortgage interest rates and the 10-year T-bill. So again, we go back to where everybody thinks today is abnormal, but this is normal, and what happened 3 or 4 years ago was abnormal.
Yeah. We're normalizing over decades.
Yes.
All right. So I mentioned this earlier, and Joe, we talked about kind of the peak of the market, which was here.
Yeah.
And that was in 19. And then we saw, obviously, it dropped like a rock in 20. And we know why, because of the virus, right? And basically, Joe, here's the bottom line, right? This is a major factor in loan originations that is seemingly not talked about. And Joe, let me just clarify this. Mortgage underwriting through 2014 and 2019 was not considered to be aggressive at all.
No.
That was 2000 and prior to 2008 when we saw that, which the index back then was like 900 or something, crazy number, right? But we look at it over, we're just about, Joe, where we were. Where we are now, and if you go back, we're hovering right around where we were in 2011, 12, and 13.
Yeah.
right? We're almost right in that range right now. So underwriting is about the same that it was back then, and this was a seriously recovering mortgage origination market.
Yes,
because obviously they've just been through hell and back as far as underwriting and defaults. And so I would say that this is where we think is a big factor, because this leads to the opportunity in seller financing, right? You don't have to seller finance somebody that's got terrible credit and misqualified. Right. You just finding somebody that's been left out of the market today is a way better grade of buyer than there would have been in 2019. Is that a fair statement, Joe?
100%. Yeah.
Right. So this is why we see it as a market opportunity, is because the traditional market is leaving so many people behind, right? And that's why part of why we say that we look at these cycles and we try to look at it. And today, the biggest thing that we see is that we run this math, Joe, all the time, all the time. And it is seemingly more profitable to seller finance the same property that you would have rented. And we do this math. We live in this all day, every day. And you come to one of a NoteSchool training, you're going to hear about it, but we're going to show you why we say it. We're not just saying it. We're going to show you why it's true, why the math is so extreme right now in this area. So let's talk about commercial real estate.
Yeah.
Let's talk about some dimensions of the commercial market. And what's interesting is you're going to start out talking about commercial, but it actually addresses single family too, right?
Well, that's a big part of it. So these are detached rentals, single family. Rent growth again, decline by 2%, second straight month that's happened. Florida is just off the charts right now with vacant rentals and landlords trying to get rid of them due to the fact that, they're saying maintenance has gone up 50% as well as insurance rates has gone up 50%. So perfect time for what we talk about here in Florida, Eddie. Perfect time to take those rentals, single family rentals, and turn them into seller financed notes to good folks.
Well, we talked about the value slide in Florida, but it also mentions California, Texas.
It does
as well, and so that's worth noting. And so, Housing Wire did an article on that, and you just that's kind of the headline, but there's a whole story behind it that's really kind of saying what we're trying to pay attention to, right?
Yeah.
All right, let's talk about Fannie Mae. Mortgage fraud. Oh, say it ain't so. Never heard of this before.
Right. So the single family portfolio for Fannie made $938 million in 2024. The multifamily portfolio lost $752 million in 2024. So that sucked up a lot of that profit on the single family. And again, driven by higher multifamily, attributable to incremental decline property values, rising delinquencies. And then the biggie, Fannie has discovered instances of multifamily lending transactions in which one or more of the parties involved engaged in mortgage fraud and loans that they have already closed in that fraud piece as well. How about that?
All right. So this is a trend every time you see a declining market. First of all, the market is declining, right? Values and delinquencies.
Yep.
Okay. And then when that happens, then all of a sudden things start popping out. And inevitably it happened. It happened after 2008 that we saw this incredible amount of fraud that popped out, right? It doesn't pop out as much when things are really good because it covers lots of sins.
Yeah.
When things, what did Warren Buffett say about the tide?
Yeah.
It's kind of that, isn't it? When the tide goes out, you find out what?
Yeah.
Who's naked?
Who's naked? That's right.
That's what Warren Buffett's saying. So this is not a shocker at all. And I tell you what, it's worth standing up and paying attention to when they lost $752 million in the multifamily portfolio. So those losses are not going to, my prediction, those losses are not going to be better this year.
No. Nope.
Okay.
So, yeah, we've been talking. Rents keep dropping as supplies continue to surge. 17th consecutive month of year-over-year drops, with smaller size units seeing the biggest declines, Realtor.com. But all sizes saw drops in price. Studio apartments and 3-bedroom units were the biggest. And even though a lower rate of completion is expected for 2025, still it's going to grow by 1.1%, with 49 million units completed by the fall in the single family or in the rental apartment market. That's a lot.
Joe, it's very funny when I travel around the country, I talk to people with very different perspectives, and people will describe a market. I was in, Middle California on the coast on last Saturday, right?
Yep.
They're like, well, everybody else is dying, but California's great. And now let me say this, there's a unique market in California right now because all the people have been displaced by the fires.
Right. Yes.
Right.
Yeah.
Which is a terrible deal. And
horrible.
By the way, luxury, like insane luxury apartments, they're just naming their price.
Yeah.
Like, because their gigantic mansion burned down and they're paying $35,000, $50,000 a month for super luxury apartments, like super duper stuff, not normal apartments. But I'm just saying that we've been watching this ball and the market is now reacting the way we said it was going to. You go back and fact check us 2 years ago. We've been saying this is a problem. This is something we're very concerned about. And now all of a sudden, but it took a long time for it to really unfold, Joe.
It did.
Yeah. Let's talk about non-performing notes.
And that's what's happened here as well. So homeowners, particularly first-time home buyers, are worryingly late on specifically 5.2% are behind on their payments at FHA, 3.9% in VA are delinquent, and 2.1% of conventional. So, yeah, double on your VA and 2.5 times on your FHA loans. That has spiked up. Yeah.
Let me say this. Delinquency in residential mortgages spiking doesn't seem to be the monster.
No.
They're reporting it. We're paying attention to it, but it's still legacy loans that are the problem, right? And that's what this shows.
Yeah.
Right. So all the mortgages in the United States, 53 million. Okay. Loans that are 30, 60 days delinquent, Joe,
yep,
are loans that we just say they're not eligible for foreclosure, right? We have 214,000 loans, and not everybody's counts are exactly the same on this. We've noticed this more than once, but remember when we did the interview with Darren Blumkus and I talked about the loans in La La Land?
That's it.
Those are the loans in La La Land. Well, Joe, the average days delinquent on mortgages in foreclosure, yep, almost 1,300 days. But look here, Joe, average days of mortgages delinquent that are not in foreclosure but are 90 days delinquent, 522 days. Yep. This is why I said they're in La La Land.
Yeah, they are.
Why are they not in foreclosure, Joe?
Only I don't know who knows.
You don't even know that the shadow knows this one, do you?
I don't think the shadow knows this one. Right? We've been scratching our head over this one for a couple of years now.
Oh.
And then look at the next two. Let's look at the next two. This was what I wanted to go. So foreclosure starts in 2024, Eddie, were 321 million. You can see where I put that line, or 321,000. and you can see the ups and the downs, but that was the end of 2024. So we've got starts, and then we've got completions on the next slide, and then we'll wrap up. 69,000 foreclosures were completed in 2024. And how many did we just say were actually in that big category? A bunch.
Yeah, almost 500,000 loans.
Yeah.
So
yeah,
this is what we're paying attention to, right?
Yeah.
There is a pin-up inventory of non-performing notes. Is it politics? Is there some other variable? Like, what's influencing these loans to not get pushed down the way? And does a new administration change that?
Mm-hmm.
And what does that look like? Well, I think we look at it and say it's not healthy.
Right.
It's like mortgage, mortgage companies are losing a mountain of money with all these loans that are so seriously delinquent. And then they're probably on top of not just getting their mortgage payment, they're paying taxes, they're paying insurance, they're paying other costs related to protecting their position in the mortgage, not letting the taxes get delinquent or not let the house go uninsured. And so those are things that we just keep watching and scratching our head and going, well, these are interesting times for the mortgage industry.
Yeah.
Do we think with, a new administration that somehow that may change? The answer is seemingly. But
and Eddie, we get why there wasn't in 2020, 2021 because of the mortgage or the foreclosure moratorium. But, we haven't seen them, spike from what we know they were. So anyway, it's hopefully this is going to have to come out eventually, right?
It's got to change at some point, because I don't believe that there's any evidence that these seriously delinquent loans are curing or moving. The dial's not moving. Like, you could go back and watch a year ago, and it's almost the same math it was a year ago. Go back and watch another year, and it's almost the same math.
Yep.
There you go.
All right. That is it.
Give them some information, if you will. Oh, by the way, just remember, we are always honored that we get to win some awards along the way and do that. Joe, give them some information, if you will, about how, if they want to get involved and learn a little bit more about what we teach, how does that work?
Well, they're going to go to noteschool.com/TV. Again, noteschool.com/TV. Guys, reach out to us, and we'd love to have a conversation with you about what we can do, how we can help you to get started or to build wealth, right?
If you hadn't seen our website lately, it's worth watching. NoteSchool.com.
Check out our website. Yeah,
pretty cool. And it's got a lot of information on it. So however we can serve you, we'd love to talk about that. We definitely are teaching trends in the market, and some real estate investors are repositioning themselves very effectively in some stuff we're doing. And we'll just keep watching the market and we look at it as a weather report, right?
Yeah.
We can always make the best decisions when we got a good weather report.
There you go. All right. We will see you guys next week. Same time, same place.